I am Julia, and I am with the Singapore FinTech Association RegTech Subcommittee, as well as the founder and managing director of J4 Solutions, with offices in both Singapore and Malaysia. Otherwise, I call myself a compliance black belt. So thank you very much to Asian Bankers Association and LexisNexis Risk Solutions for inviting me to moderate this fireside chat on de-risking KYC in a rapidly evolving regulatory landscape. To me, this topic is especially important because we will be touching on two subjects incredibly close to my heart, and which are financial inclusion and correspondent banking. I've traveled quite a bit to many developing countries and saw firsthand the impact of de-risking. And for years, the concept of de-risking has had unintended negative consequences, often pushing vulnerable populations and entire regions out of the formal financial system. This has been particularly evident in the world of correspondent banking, where the withdrawal of these vital relationships have severed financial lifelines, isolating institutions and their customers from global trade and payments. This doesn't, of course, eliminate risk. It simply shifts it into less transparent channels, making our financial ecosystem less secure. So yeah, I see some answers coming in. So we have people from Nepal, from Bangladesh, from Sri Lanka. Well, keep your chat coming. Let us know where you are from, where you come from, and also keep also asking questions as well along the way. And we have with us today Vijay Nagarajan from LexisNexis Risk Solution to discuss how we can manage risk effectively while championing financial inclusion. So instead of simply de-risking, we will explore how to de-risk KYC in a smarter and more targeted way. So over to you, Vijay.
I'm Vijay. I'm Director of Market Planning for KYC and Payment Solutions for LexisNexis Risk Solutions. I look after the fast-growing markets that includes Asia, ANZ region, Middle East, Africa for LexisNexis, both from the compliance products perspective and payments perspective. So thank you all for joining in today, and hopefully we'll have a good session. So let's crack on. What I wanted to cover today are two aspects. The first one is always risk. Risk is the reason why compliance exists. Risk is the reason why we do what we do on a day in and day out basis, and that's our bread and butter. Whether it is a financial institution, whether you are NBFIs, fintechs, or anyone relating to compliance or payments in across corporates or financial institutions. The second part is the evolving market. So that's the one most constant aspect that we have. Compliance have always been increasing, and they continue to increase on a day-by-day basis. So every year there is new regulations. The regulations vary across the park as well. So we'll cover up a little bit of that as well today. Julia already mentioned financial inclusion is very close to our heart. That's one of our key aspects. So we'll cover that as well as a part of today's discussion, because financial inclusion is very key for Asia and Asia Pacific, especially with new fintechs, new technologies, and the need of compliance also needs to balance the risk aspect, but also ensure that the right kind of awareness and the right kind of due diligence is present in the market for us to actually explore and rise and grow in the way in which we need to grow, and the market is expecting the financial institutions to grow. Right. So without further ado, let me just start off. I would want to start off with FATF, because that affects not just compliance community, but also the Asian Bankers Association members. And if you see, there are two or three things that make the ABA community a little different from all the others across the world, and there you'll see that the starting points on the left hand side of the screen are quite different. Right? If you look at the FATF recommendation across the 23 member states, which are a part of the ABA membership, you will see that most of them have a long way to go. So overall, from an Asia and Asia Pacific's perspective, we know that there are challenges, there are compliance aspects. We anticipate the central banks of every country to pick that up, and we also expect a lot of regulations and focused policies which are going to be developed over the next few years, and that is going to affect all the ABA memberships and the banks across these regions. Now, if you see, there are three different flavors of it, right? The first flavor is that there are 23, 24 countries across, and even to have any form of trade or transactions or even growing across the market, it requires a lot of conjointment of compliances. So there needs to be some kind of harmonization of compliances across each one of the countries. So that is likely to be the first challenge, and that's where slowly I'm expecting the central banks to evolve. So there is going to be a common challenge, and and common kind of compliance harmonization. So which is where Asian Bankers Association is playing a very pivotal role in identifying those kind of commonalities and enforcing those commonalities across the board. The second aspect is the entire blacklist and gray list, and the entire non-compliance aspect. So that shows that there are a lot of areas, especially around beneficial ownerships, that we need to improve on. We are expecting policies from central banks to come in. The focus is also expected to be different. For example, the focus for I know there are colleagues from Nepal here, so it's likely to be a little different from, for example, Sri Lanka or Singapore or Hong Kong or India, right? So these are different countries starting at different journeys, and therefore, while the journey is exactly the same, it is likely to be a little longer for others as compared to the others. Then we also look at the sanctions entity. So we see that the third aspect of challenge, which is there in the Asian financial institution market, especially for correspondent banking, is the number of sectoral sanctions that are there across. And these are not global ones; these are sectoral ones. And in some cases, for Myanmar and Iran, there is a global sanction as well. But having said that, it just puts in a lot more pressure from a compliance community to actually do their due diligence right, and on one side balance the risk-based approach, and yet ensure that you are growing at the right pace, and engaging with all the countries and the members across the ABA community. So these are the kind of two or three likely challenges and evolutions that I'm expecting over the next few years. We are expecting a few of the central banks to start working along these lines, and from a recommendations perspective, we are expecting a good set of harmonization coming in from the beneficial ownerships, especially from UBO's ownership structure. We have seen that in Australia, Austrac is already working around improving how they have transparency in UBO and ownerships. They have started looking at shell companies and how correspondent relationships are set up if the financial institutions are shell, for example, and then how do we harmonize and have constant PEPs across the board in the same way as every other country. So if you see the recommendations, almost 23 and 22 of our countries, which across the ABA countries coverage, have some kind of road to cover over there. Sanctions will continue. It's not a easy place, especially with the Ukraine war and Israel war and so on. So we are expecting a heightened activity of sanctions going on, and therefore that will impact the correspondent banking relationships and the transaction relationships across financial institutions, especially around new technologies. Now, this is quite new, and this is has a heightened focus. So I was in the Risk Ready event in Nigeria a couple of weeks ago, and then the Central Bank of Nigeria is focusing specifically on new technologies. Now they're putting in policies around virtual assets and virtual asset service providers, and how they impact the entire relationships, the way in which the FIs interact with each other, and then more importantly, understand how the entire complexities of having traditional banking, the correspondent banking, as well as new technologies all come together in the form of regulations, because most of most of the virtual assets have across most of the countries have not been regulated yet. So we are seeing that activities come up. Risk assessment is something which is a good improvement that I've seen across countries. There are a few countries that still have to do to cover up the few edges. But when it goes to risk-based assessment, I think that is one of the most common words I have seen across the compliance community. Now, almost everyone knows the risk-based approach as much as what we are seeing across. So then it is how you extrapolate that risk-based assessment to balance the growth and the compliance together is going to be the key. A key part of the risk-based assessment is going to be how helpful the tools and the technologies are likely to be in order to aid you in all these recommendations. So, how can we have new tools for beneficial ownerships, identifying PEPs to identify triggers when that happens, when the regime changes, and even on an ongoing and BAU perspective, how do we ensure that the risk-based assessments are constantly maintained and the risk positions are monitored on a constant period? So that's going to be the challenge going forward, and therefore tools and techniques are going to play an important role, and I'm expecting that to go in as well. Now, from an evolutions perspective, what I have done is I've gathered across a common themes of where the compliance focus is likely to be, and not just from Asia's perspective, and also what we are seeing across the other fast-growing markets, and including established markets like US and Europe. 4 or 5 big things that are going to come your way, apart from the risk-based approach, is likely to be the heightened screening and sanctions tools. There is a discussion, especially from an AMLD6 perspective in Europe, around secondary sanctions, and how do we make the sanctions and screening a lot more transparent. We know Austrac is working around different technologies and tools around identifying ownerships and screening as a part of that ownership. But we are likely to see a lot more emphasis on screening and sanctions, not just at that as in a siloed basis, not just at the onboarding side, at the correspondent banking relationship side and the transaction side, but it is going to be a common value stream journey across the board. So whether it is a trade relationships, a trade financing, or remittance, or money service business, or even correspondent banking, we are expected to see a harmonization and consistency across, right from the time you're onboarding a partner all the way to actually doing the transaction and monitoring the transaction over a period of time. So that's something that we are likely to see coming in over the next few years. We are also seeing UBO. So I know ownership is something which is getting highlighted, but UBO and ownerships are quite important, more from how we currently operate UBO versus how the expectation of UBO is likely to change over the next few years. For example, the traditional way, as me being a compliance analyst in my past roles, I have always used compliance by asking ownership from a document from coming in from a bank. So if I had a correspondent, I would go ask them for the documents. UBOs and ownership documents would be one of the documents which will be submitted. I'll wait for 3 or 4 weeks. Julia says it can take almost up till 6 weeks. So we wait. So we get that document. Obviously, it'll be in a different language. We'll get the interpreter to convert it, translations, and then afterwards we'll start calculating it. Now, that is restricted to a direct UBO, right? Then you start looking at how you start digging deep into it. So how do we start looking at levels of ownership across? So who owns that corporation? Who owns that corporation? So then we are trying to interconnect the ownership charts in order to build a full picture, because that gives you a new set of risks, like aggregated risk or collective risk. Can a group of companies own a few companies here and there as an indirect owner, and then have a correspondent complete ownership and then decide the strategy of the firm? Or can a group of UBOs collectively join up together and then decide the fate of the firm? So these are collective and aggregated ownership, which are quite important, and that doesn't come up with a just a joint piece of paper and just looking at one level of ownership. So we are talking about multiple levels of ownership which are there, and there are tools out there which provide you with that interconnections. And obviously, as a compliance community, that is a good picture to have, especially if you want to strengthen the risk-based approach. Last but not the least, the new technologies and tools. Now, the new buzzword that I'm hearing across the central banks as well is some kind of trigger-based KYC. Now, you would have learned or heard about trigger-based KYC. You would have heard about perpetual KYC. You would have also heard about conditional KYC. What it basically means is uh, things go on as business as usual. There is a trigger. That trigger creates an alert. The alert in some of the financial institutions may be a material alert. In the others, it may not be. It could be a material alert in some jurisdictions. It may not be in some jurisdictions. Now, these are the flavors of what you are likely to see. And based on those triggers and alerts, you're expected to do a due diligence, which otherwise in my previous role, I would have done correspondent banking assessment once in a year, once in 2 years. It'll take me around 3 months. I'll take my time, finish it, and then submit it for somebody to sign, and the chief compliance officer would sign it. Now, that is slowly going to be phased away over the next few years. Now, that is going to be more responsive, that is going to be more trigger driven, and that means there needs to be a certain set of tools and set of capabilities which are available from a compliance community to in order to respond and meet those kind of requirements. So these are the top 5 or 6 things that I'm expecting across. So what it all means at the end of the day, it means that compliance is no longer one set of journey. It is going to be across the journey, whether it is the onboarding or the transaction monitoring, and it is likely to be multidimensional. It is going to include the risk of the financial institutions. It will also have a component of fraud and identity associated with it. It'll also have some kind of an ongoing monitoring of screening and transaction monitoring and fraud monitoring into it, which we are seeing across. And we are slowly seeing fraud and identity and transaction monitorings across the flags coming together alongside with the screening part of it. And then obviously the core pillars of sanctions, PEPs, UBOs, and the core due diligence are likely to continue as it is. It's just going to be a lot more responsive and not a periodic one or a set time driven activity anymore. So these are the impacts of how we are expecting the compliance to be evolving over a period of time. So at this point, it's a right time for us to actually talk about. So Banker's Almanac is one of the tools that is from LexisNexis Risk Solutions, and yeah, it's one of our flagship counterparty KYC tools, which almost most of the financial institutions use it. This is important for us. While we are talking about the compliance and the evolution aspect, the second facet of it is what does it mean from a bank's perspective? So at the end of the day, we are in a business to keep our banks and financial institutions safe. And that's why technology solutions providers like LexisNexis is important. That's why even banks are important. You are there to ensure that there is a financial stability into every jurisdiction that you operate in. So the three complexities that are likely to come in when you start looking from a strategy perspective and how you have a compliance transformation. There are three complexities. The first one is the use cases. So I know there are big banks, there are smaller banks, there are digital banks, there are medium banks. All of them have a certain set of use case variations. So it could be trade finance, it could be cross-border remittances, it could be corporate banking, or it could be lending or even correspondent banking. It depends on how many currencies you support. So that's the first kind of front-end variations that you're likely to see, which are directly impacted by compliance. The second part is the regulation itself, so which is the middle part of the section that you see. So that depends on how many countries your bank operates in. So if you have uh, a bank that operates in Malaysia, Singapore, Japan, and India, there are 4 or 3 different jurisdictions, and all of the compliances are evolving. So in those cases, how do we harmonize those jurisdictions across? How do we have standard risk-based approach across the value chain? Doesn't matter whether it is there in India or in Malaysia. And then how do we then understand the flavors of RBAs across and then fine-tune them is where the bang of the buck is. So therefore, the compliance complexity is important. Now, the basis of these compliance complexities is obviously about checking out and ensuring that we are doing the right thing at the right time. So which means it has to have something to compare it with. And that's where your footprint and architecture comes in. So where you have different compliance architectures and compliance tools and compliance solutions for India separately, for Malaysia separately, for Singapore separately, for a bank, if you have a common set of solutions across and harmonize them, it is easier for you to either drive workflows or build AI solutions on the top of it and then move on. So that's going to be the key as well. So these are the top 3 things that we are that is likely to be the challenge for financial institution communities. And I would like to know a little more about from the audience itself, and let the questions keep coming, and we'll answer those questions as we go along. The focus is again, how do we contain the cost of compliance but still be as effective as we need to be? This one is a little bit about Banker's Almanac. We are 180 years old, and in fact we are celebrating 180th year this year. It started off as a book back in 1845. Somebody came in, started listing down all the banks, all the branches, all the contacts, the personal contacts, and then from that book that you saw almost 180 years ago, it has come down to a full-fledged web service with APIs, customized file, and ready for the future for the tools that you see today. So whether you have workflow, whether you have automation, whether you're looking at perpetual KYC, we are building tools that sits on that particular data and then connecting all the integrated solutions across. There are a lot of things that Banker's Almanac currently contains. Initially, it just used to be branch and bank names back hundreds of years ago. Now it is a lot more ready for electronic payments based on domestic and cross-border payments. It has standard settlement instructions. And from a compliance community's perspective, it has everything that you need from over 200,000 financial institutions and 26,000 bank and bank-like entities. So whether it is CBDDQ, SOE, SME, flags, sanctions, multiple interactive UBOs, multi-level UBOs for you to identify, those are available. And then obviously, right from a financial stabilities perspective, all the due diligence documents, licensing documents of all banks across the board. The aim of the product is obviously to crash down the entire cycle of due diligence time that you take. And it has helped almost 97% of all the largest banks across the world. So that's Banker's Almanac a little bit more. We are celebrating 180 years, and that's one of the reasons why we are having this seminar today. So at this point, I'll probably hand off to Julia and open up for discussions.
Well, I first heard about Banker's Almanac way back in early 90s when I started my career in the bank. And it was like the yellow pages for bankers. We used we used it to look for telex references. So I mean, it's good to hear the name again after so long. And good that you actually kicked off with FATF, because as we all know it, earlier this year, the FATF has strengthened the recommendation, one of the standards, to reinforce the expectation that we must look through proportionate and risk-based approach and encourage countries to promote financial inclusion. And of course, we know also that the guidance on financial inclusion has also just recently been updated accordingly. Now, not only should we be looking at compliance with the 40 recommendations, but I think it's important also to consider the effectiveness, which is where the immediate outcomes come in. And we see also the convergence of fraud with money laundering. So things have gotten more complicated since the day I touched a correspondent banking due diligence file, maybe way back in before 2020, before COVID actually. So yep, and I thought that'd be good for us to kick off with our discussion to focus on some of the challenges, and also for the audience, if you face any challenges that you would like to share or any questions, do keep the questions coming. And yeah, so maybe we can start off with talking about some of the challenges that we face with Vijay.
Uh, I think the challenges, especially that we face, is exactly what you said, Julia, right? Compliance that we did 10 years ago, 15 years ago is way different from the nature of compliance that we do today. Uh, I wouldn't say it is very complex. The tenets are still the same. You still have to look at the common principles, which I call the first principles of compliance. You still need to do risk assessment. You still, at the end of the day, look at the North Star of, is this going to be the right kind of FI institutions to have relationship at that particular point of time. And it is all about that particular moment, because in a compliance community, the moments keep changing based on every event and trigger that happens, right? So that's one of the complexities and challenges that we face. But from an Asian communities perspective and financial institutions perspective, most of the banks that we see are multinationals, right? We call them regional banks because they are across Asia. But having said that, we have network banks across the Asian community. So even in across, there is no a common AMLD kind of directive across the board. So the first challenge that the Asian banks generally face is the multitude and the divergence of regulations. So if they have operating office in Malaysia, Singapore, Hong Kong, and India, for example, it's going to be different. And if you are talking about an Indian bank having an offshore operations, it is going to be different. The starting point is different, and the way in which it needs to operate also is different. The second one is the focus areas. Now, from a central bank's perspective, the focus areas across different countries are likely to be different. So if you look at Malaysia, the Banca Negara Malaysia is looking more compliance as from a remittance perspective, because there is a lot of remittance coming in and going out. So the focus is very high on money service business and how do we drive compliance within the money service business, because that's the focus of Malaysia at that particular point of time, right? Now, move that to India. India is more looking at financial inclusion, which is the key, because we have a billion people out there. Then what happens is, how do we then have uniform KYC across everyone? How do we enable that tool sets? How do we drive technology, whether it is UPI, whether it is unified ID, or Aadhaar across the board? That becomes very important. So we've already seen transactions blow up and compliance blow up in that area, but then it has driven financial inclusion to the next level, right? So that's a success story right there. And then if you go to Australia, Australia is looking at more from a compliance and risk-based approach. So it's a completely different mindset. If you look at Singapore, Hong Kong, very similar mindset. So they are looking at trade as a key, and that is likely to play a good role. Then they are also starting to look at transaction monitoring alongside your correspondent relationships. It's no longer enough for you to do a due diligence on correspondents and trade partners and counterparties, and then go and execute the transactions at the end, because you have to be consistent across the journey. So that's where Hong Kong MA and even MAS is focusing on. Now these are different flavors. Pacifics are focusing on financial inclusions. Now, that flavors is the second complexity that the financial institutions are likely to have, because now they have multiple facets of regulations and requirements that they have to tick off and align them together. So the third aspect is the underlying capability that the bank has. So if a bank operates in all these markets, how do you then keep your compliance cost constant? How do we have the same solution which monitors risk appetite and risk-based approach across the same countries in a same way or a consistent way? So that becomes the third challenge. So these are the three big challenges that you're likely to see from a bank's perspective, and this will continue. So initially, 10 years ago, it used to be Chinese walls, right? So the Indian arm will work like Indian arm, and the different countries will work separately. Now that is no longer going to be the same, because that's going to be cost inefficient, and that's going to drive up compliance cost across the park for a financial institution.
Yeah, that's also because criminals have gone cross-border too. And interesting enough that you mentioned also different countries have a different risk appetite, and I can see that even with recommendation one coming in, risk-based approach, each country will have a different flavor to it. I just recently conducted a workshop on correspondent banking. While the word banking itself feels like it's meant for bank, one thing I really highlighted during the session was that the Wordsworth questionnaire, the most recent revision 2022, highlighted that on a risk-based approach again, to also consider looking at the rise of NBFIs as well as the new payment technologies, as you also highlighted, recommendation 15, there are 10 countries within ABA membership that are either partially or non-compliant. And basically, it's also because of the significant risk of testing, where these businesses are using the bank's correspondent banking relationship without the bank having full knowledge of it. So yeah, so generally, I would say that that's where we are.
Yeah, absolutely. And the whole aim in the entire thing is the risk-based approach. So therefore, having it consistent, uh, having the RBA consistent, as well as containing the cost of compliance is key. So if you see, I think there was a PwC a report that came out, or a survey that came out earlier this year. And what they've said is almost 82% of all financial institutions are currently thinking about some kind of compliance transformation or the other, right? Which means that there is a very heightened focus across the banking community to start looking at compliance holistically and start containing the costs and improving the optimization and the efficiency of the entire compliance process. So that's one focus. And obviously, exactly the second point that you made, it's no longer banks only. So it is NBFIs, it is fintechs, it is payment aggregators, PAPGs, PISPs, you name it, across the board. The breadth of the compliance have now increased. So therefore, you're no longer FI to FI kind of relationships in a correspondent bank. It could be a little different than it was a few years ago.
Yeah, we've been talking a lot about the risk-based approach. Let's also look at the balancing a risk-based approach with business growth. So the risk-based approach is a very tricky one, because it on whose risk appetite, right? Each country, each organization will have a different risk appetite. On that, I thought that I would like to address this question from Muhammad Firoz Alam. He asked this question: how many layers do we need to check or review to identify the beneficial owner or ultimate beneficial owners of complex ownership? Personally, I felt that there is a standard. The standard is probably 4 layers or so. But then again, sometimes you also need to look from a risk-based approach. Is that does the business model make sense? So, say for example, if it's going to be an international corporate, say for example, a I will just use Malaysia as an example. If a YTL group, 4 layers may be justifiable, but then if it's going to be a company that is of smaller size with less complex businesses, I think, we can't just say that 4 layers, full stop. So we have got to consider from a risk-based approach as well. So that's one question answered live.
Yeah.
And yeah, I happened to see the question and I thought it's good for
and
us to
and the same
discuss that.
question made me smile as well. And it's a very easy thing, and in all the answers to the compliance, just like this, it all depends. It
Yeah.
depends is the only answer that you say. But if you see AMLD directives and some of the European financial institutions that we work with, they have to some extent mandated a 4 level or a 3 level or a 4 level kind of UBO checks. So that's something that they have started looking at. Aggregated ownership is another thing that they have that a few of the financial institutions have asked us about. Especially from Ukraine war, they've started asking us for collective ownerships. So even from PEPs and sanctions, how many of the PEPs or sanctions are there, and from that, if there are UBOs, how many UBOs collectively own that particular entity is another question that we have been asked. And these questions surprisingly has not been asked only for financial institutions. It's also for fintechs and paytechs, right? So if we have a paytech or a PAPG that a financial institution or a bank is relying on for its customers and connections, whether it is a pass-through correspondent, then it becomes very key, and therefore you need to follow those kind of multi-level UBOs, and that's going to be the key. Now, obviously we are not going to give an answer saying 3 is the right answer or 4 is the right answer. If I could have given, then I would have expected the central bank to have that regulation in place. The answer is not that. The answer is, who are you dealing with, who's the correspondent, and who's the counterparty, and that defines how many levels you need to go. And the factors and the triggers holistically will tell you how many levels you ideally have to go. So if you have an enhanced due diligence necessary, if you want to do that every 6 months, then your UBO levels will slowly increase. If you suddenly see a lot of flags, adverse media flags across the board, you will start increasing. If you start seeing CBDDQ questions not in order, don't the compliance postures not in order, then you will include that along with your UBO to get a holistic view of the risk. So that's the kind of answer that you would have, Mohammed.
Yeah, I've done some work in the Pacific Islands and some countries that are on the grey list, and where banks have actively de-risked their portfolio is also because the cost of CDD is expensive. So if we are going to end up having to do a lot of CDD while the revenue is low, so it makes a lot of sense, and we can't blame the banks as well for de-risking. But of course, it severely harms the financial inclusion part. So I think one area is that to see how we can manage risk effectively without sacrificing the profitability as well as the socially beneficial business relationship as well. Say for example, a bank in some island where there is only about 10,000 population, but then again, they still need banking services, right? How do we handle that? And I thought that I'm going to be jumping from one question to another, depending on, the conversation that we have. I see the question from Connie that asks, do you see digital identity system, for example, eKYC, national ID program, going to help or be complicating the de-risking effort? What are your thoughts about that?
Interesting question, and that actually proves the one of the slides that I went through, right? So if you look at it, the front end is the use case. So Connie, you're exactly right. So there are front end use case variations. So you have lending, for example, or you have buy now pay later, which is exploding across most of the Asian markets. You have trade financing, you have remittances, your money service entities. Now, those are front end use cases which are more dealing with customers and users of the system. So when it comes to those kind of platforms, your eKYC, your national ID programs, your Aadhars, for example, or even some of the other citizenship ID cards are going to be the key tools for eKYC from a front ends perspective. But then slowly, as you start moving in from the user, the B2C and customer based view of the world to slowly into correspondent banking, your remittances, your number of currencies that the bank will have to support, the number of partners and correspondents it needs to have for every currency. So if I am supporting 40 currencies as a financial institutions, I am dealing with 40 countries. And in those 40 countries, if I have two correspondents per currency, at least, because I need to have business continuity or operational resilience, so then I'm talking about 80 correspondents or 80 counterparties, right? So then the eKYC aspect no longer applies. Then you are going with traditional due diligence aspect of going by correspondent relationships, asking the right questions, going with the six pillar approach, asking them for CBDDQ and FCCQ, asking them for AML compliance programs. How are they in control of the terrorist financing controls, etc. Now those start making a lot more sense. So yes, if to answer the question, do you see digital identity systems playing a role? Of course, yes. But that's in the front end of the system where you're dealing with users and customers for your day-to-day provision of products and services as a bank. When it comes to middle layers or relationships with interbanks or different jurisdictions, then the answer is a little different.
Yep, and then there's one question from Samir. This is something very close to my heart, so I'm going to jump on it. Is that as we need to balance business and compliance, can a customer UBO declaration be considered as a solution? My answer, based on my past sins as a compliance officer, I'll tell you that a UBO declaration from the customer is worth less than the paper it's written on. So whatever that we do, this can only be a last resort. It cannot be used as any way to get around doing a UBO or unwrapping exercise. So and of course, if we want to definitely as a last resort be able to use this UBO declaration, we better have very, very good justification for that. I don't know what you think about that.
I think you put it more politely than I did. It's like uh, asking a no objection certificate from a person, right? Rather than doing so there is something called as a DBS check where you do criminal checks for you before you join the firm, right? As a banker, I got done on me as well, and all the employees do that, and all the banks do that across the world. It's so if the bank were to ask me to provide a certificate, obviously I'll provide the certificate on my own, right? And which will look a lot more rosy and everything else, and with the right kind of information just to answer that question, right? But the right thing to do is basically for bank to go into the authority and then do a criminal checks, etc., etc., right? So that's an independent source that is able to trustfully vouch saying that this counterparty is good with the right kind of data in the market, right? And that is key, and that's where I think Samir's point comes in. I can always go to my counterparties and ask them for a UBA document, and I will get a UBA document from a bank, no questions. But that's going to be at level one, right? They are going to say these are all my UBOs. But if there is a shell entity on the top of it, and that is owned by somebody else, then the shell entity has to be assessed as well, and that entity has to be assessed as well. So that kind of interconnection is something that they may not be able to furnish, right? So then what happens is at the end your risk, you are sitting on an unknown risk. So that's where tools like Bankers Almanac have solved that problem, because we have 200,000 financial institutions and their UBOs already in place, right? So when we have those UBOs in place, we exactly know who owns who, and who is their owner and who's their owner. So then you can very easily create an interactive uh, business ownership chart, which will tell you that this particular entity in question has this tree of owners across the board, and this is all the sum of aggregated ownership across the board. And that ideally may or may not be possible as a compliance analyst to have that view. Or even if we have that view, it may take probably a week for us to actually calculate and identify and draw that chart ourselves, which is humanly impossible. I don't see anyone doing it as analysts, because we are always running against time. So then it becomes this kind of tools becomes all the more important. So the having that interactive UBO is quite something that most of our users have appreciated. So that's something that is a tool that helps you do the job effectively.
Yeah, I got a question here from Mohammed Salah on how can AI play a role in de-risking KYC in evolving regulations in the future? Of course, I would like to also say that Bankers Almanac is like Yellow Pages. Until today, probably all banks around the world subscribe to it, but whether or not people really know how to fully utilize its capabilities. But anyway, back to the story about, how AI can play a role.
AI is the most common term, I think. In most of my discussions, AI has always come up when it comes to compliance. AI is going to be a
Here to
good
stay.
positive. No, it's there to help. So the way AI is built is you need to have a data source. A data source has to be a trusted data source, or you collect that data and then put it in that data source. So that's your starting point. And then the AI tools or the workflow tools are built on the top of it. So there are two or three things that, for example, I can at least talk from the way in which LexisNexis is thinking about the entire compliance view of things. So the way we do is, because we have data of UBO and sanctions and flags and all the others as a part of data, we can do three or four things. The first thing is the workflow. So if we develop a workflow, the way in which it'll approach is, workflow is going to help you simplify from one step to another. It's not going to help you decide. It's not going to help you say, oh, this is the right decision, or interpret that data. It is only going to help you do things faster. So that's workflow. The second part is API, which we are starting to build across in Bankers Almanac. Not just having a repository of data and saying, here is the CBDDQ, but we are giving that to you, and then we are creating triggers. So that impacts and aids the way in which you do conditional KYC or perpetual KYC in the future. So the fact that there is an API which will tell you tomorrow saying, there is a flag which has come in, or there is a new document that has been submitted, take a look at it. So that is proactive compliance postures. Now that is driven by APIs. Now APIs going to help you in taking the right decision at the right time, but you're still taking the decision, you're still interpreting the part. Then we are talking about AI. Now AI is, it could be agentic or it could be generative. So in agentic AI, I am asking the questions. Tell me the UBO or the aggregated ownerships. What are the risks I'm taking? What has changed in the last 6 months? What are the new documents that have come? Are there any changes in my PEP? Now these are questions I'm asking that system, and the system is answering that information. So which means it is interpreting the answers and to the question, and then giving you that answer as a part of interpretation. The decision is still at the compliance level. The generative AI, which is the highest form, which is probably likely to come in 5 or 6 years' time, that is where you are going to say, give me a compliance report on ICICI Bank. Give me a compliance report from the past 6 months, or a repeat assessment report in this template for this particular DBS bank. So when that happens, the AI automatically generates all the information based on the latest one, compares it with the older version, and then tells you these are the list of changes that are happening. And therefore, these are the right steps that you need to take. Now, that is the best part of how AI can be used. Now, these are all the variations, but that's a journey. It's not a something that can be generated instantly. We'll also have to monitor because AI has hallucinations, so it still needs to build that trust and train that algorithm and so on and so forth. So those are the kind of variations. And AI, does it play a part? Absolutely yes. In 4 or 5 years time, I would expect some kind of AI tools in the market which automatically helps the compliance analyst with their due diligence.
There is one question actually earlier about which I thought that it will be good for us to also discuss, how we can strategically leverage technology and process improvement to manage compliance costs. And there was a question actually about what's the difference between perpetual KYC or something like that. Okay, just looking at. Oh yes, please give example of perpetual and conditional KYC. Do you have any insight into that?
Oh, good. That's a good question. I'll give you an example of KYC. So a few years ago, I think it was what 2 or 3 years ago, there was I don't know if you know about Silicon Valley Bank. So Silicon Valley Bank was one of the banks um, which obviously had to be dissolved, and it had quite a few number of B2B relationships, correspondents. A lot of other banks across European Union had really correspondents with Silicon Valley Bank, and there was a lot of transaction flows, which, from a payments perspective, also via Silicon Valley Bank, and obviously that bank got converted into HSBC Innovation Bank, but there was this period when suddenly there was a risk on this bank. And when that happens, and that's common, it's not just Silicon Valley Bank, it's generally common across the board. So when that happens, that is a material risk if that is one of your correspondents or even within the chain of your correspondents, because your transaction is at risk, your clearing is at risk. It could be it could be a receiver correspondent or it could be a sender correspondent, and that can be at risk. So therefore, you will start having to look at your existing correspondent lists and see what exposure they have to SVB. And that was one of the key things that we saw in the market a couple of years ago, where that happened. The second one, and obviously the more known one, is the Ukraine war, right? So when Ukraine war happened, a lot of oligarchs and people got sanctioned, and these sanctions started coming up. So when these sanctions started coming up, then start to have exposure assessment of all your counterparties, and there was a spike of correspondent assessments of across the financial institutions. So when that kind of events happen, obviously that will trigger a material risk, and that whether it is a material risk or not is based on every bank. So a small bank somewhere may not be affected by it, but unless you check it, you will not know whether it is affected or not. So these are a couple of examples of having trigger based KYC. Now that is a trigger. So which means there is a conditional KYC. So there is a condition, the trigger is getting created. You assess whether the trigger is material. Based on that material, you do an assessment, right? Perpetual KYC means you constantly check it for any trigger to do the same thing again and again and again. So it doesn't have to be waiting for a trigger and then checking for materiality. You can directly check it on an ongoing basis. So that's continuous KYC or probably perpetual KYC, which is a lot faster. I hope that answers the question.
Actually, there's one question that I really would like to have answered as well. Is personally interested in it is in the era of digital banking. What key measures should banks take to strengthen KYC and reduce cyber risk? Well, I well, it's not really like totally what we are talking about today, but I think having you, Vijay, as an expert in this area, you may want to take a step at it.
Oh yeah, that's a favorite question for LexisNexis Risk Solutions, because we are in three businesses. One is financial crime. we are in fraud and identity, and then we are in payments, right? Correspondent banking, KYC, and payments. So we don't look at these as three different businesses. We always look at cases where, um, if you look at the fraud journey, or cyber attacks, or if you look at money mules, and I think one of my colleagues did have a money mule session a few months ago in the with the Asian Bankers Association. So in all these cases, what happens is whether there is a threat from a fraud and identity perspective, or a cybersecurity threat, or whether it is a compliance threat, all these things are different facets of risks. And as a risk manager and a compliance manager, you need to look at all the various amount of risks and the risk appetites that you have for each one of the entities across the bank, and then ensure that they are in compliant. Now, how do we then connect the dots between the fraud and identity and financial crime, and for example, payments and correspondent banking, right? So when you do a trade financing, you do a counterparty assessment. So that's where KYC comes in. But once the KYC is done, which you probably said typically takes a few months, but once it's done on that counterparty, you then do a KYC on the user and the exporter or importer on one side, and then after that you actually have to do a transaction. So at that time, the transactions, if it is a trade transaction, we'll have to start screening the transaction for, chemicals or prohibited items, or goods and specific goods. So then in those cases, that has to be consistent with the requirements across in that particular jurisdiction. So that dot has to be connected. So we have connected those dots. Then it is the identity and fraud and cyber attacks. So during these transactions, ensuring that every correspondent entity, the the elements are are joined up. We obviously have solutions for transaction monitoring to identify patterns, to identify the ways in which you identify fraud, and then raise that fraud and or monitor those transactions. So those are some of the other solutions that we have come in. So sanction screening, fraud flags, and even compliance, all of them are joined up from a organization's perspective, and and that's why I like that question, because very few entities and banks look at it holistically. They look as one or the other, but at the end, all of them are risk, and that's what we stand for. So it doesn't matter where the risk is coming from. The weakest link is where you are compromised.
Well, we've come up to the hour, so I thought that I will want to also say something before I pass it to you, Vijay, for the closing remark, is that, remember this, criminals are coming together and have organized crime, commit organized crime. And so we, the good people, must also organize ourselves and come together to fight financial crime. So with that, I pass to Vijay for your closing remarks.
Thank you. I think it's been enjoyable session for me. I'm sorry that I couldn't go through all the questions and answers. Um, 1 hour always seems to be less when we have good topics and good questions coming in. Um, but otherwise, I think from the closing remarks perspective, I hope this discussion was useful. My teams, Julia and I, are always available. We are on LinkedIn. We are there to answer questions. What we'll also do on the back of this call is basically take all the questions out, and then answer them, because it takes effort for you to ask those questions. So we don't want it to go waste. So we'll follow through in the next 1 week, and we are open. We are there, as Julia mentioned. We are a community. We have to do things together. We are in it together. So whether you are a technology service provider like us, or whether you are a financial institutions, our job is to keep our clients safe. And every transaction that goes through is from a trusted source. So that's what the business that we are in. And I think the ABA members are doing a very good job with the complexities that we went through in the FATF, and the number of countries, jurisdictions that we operate in. It's an amazing and tremendous one.